Okay, let's unpack this. You shared quite a stack of sources with us. We're seeing everything from these like staggering CEO paychecks and hot chicken deals.
All the way to complex global trade stuff and, the very foundations of the U.S. economy. It's a real mix.
It really is. So our goal in this deep dive basically is to sift through all these articles and reports you sent over. Find the important bits, right?
Exactly. The surprising facts, the insights, maybe connect some dots between topics that look totally separate at first glance.
Think of it as your shortcut, maybe, to getting up to speed on some of the biggest business and economic stories making noise right now.
Yeah, we've got stuff on the highest paid execs, some breakthrough tech like brain
Oh
implants.
yeah, that one's wild. And shifts in real estate, the latest on U.S.-China trade tensions.
What the Fed's thinking about interest rates, and crucially, how all this national debt stuff could actually, hit your wallet.
Quite a range. But hopefully by the end of this, you'll have a clearer picture of how these pieces kind of fit together and why they matter to you.
Let's do it.
Absolutely. So let's jump right in. Something that always gets headlines, the big paychecks. We saw that analysis looking at CEO compensation.
That's right. The Wall Street Journal crunched data from iLogicQ, looked at over 400 S&P 500 CEOs, ones who'd been in the job at least a year, and the scale at the top is pretty striking.
Striking feels like an understatement.
Yeah.
What did they find for, like, the majority of these CEOs?
Well, over half of them, they made at least $17.1 million in 2024. But then you get to the very, very top, and the numbers just go into another dimension, almost.
Okay, so who was leading the pack in this analysis?
The absolute top spot went to Rick Smith. He's CEO of Axon Enterprises. His total package was valued at, get this, $164.53 million.
Whoa.
Yeah, and that was the only one over 9 figures in the S&P 500 last year. But the key thing, the sources stressed, it wasn't mostly salary.
Right, it's the performance stuff.
Exactly. Overwhelmingly driven by stock awards tied to hitting some pretty aggressive performance goals for Axon. They made tasers, other gear, market cap over $58 billion.
That $164 million really highlights how much CEO pay now is tied to that performance-based equity, doesn't it?
It really does.
Who else was way up there?
Number 2 was Larry Culp Jr. from GE Aerospace. His package was $88.95 million. He used to run the whole GE before they split things up.
Okay, and third?
Steven Schwartzman, Blackstone, the private equity giant, he came in at $84.03 million. Blackstone manages, nearly $1.2 trillion now? He co-founded it way back in the 80s.
And we saw some familiar tech names in the top 5, too.
Yep. Tim Cook at Apple was number 4, $74.61 million. He's been leading Apple since 2011, right?
A long time. And rounding out that top 5.
Joseph Bay. He's co-CEO of KKR, another big investment firm. $73.09 million for him.
And the analysis mentioned a few others in the top 10. Carrier Global CEO, the other KKR co-CEO, Netflix guys, Simon Property Group.
Right. It really just underscores that incredible concentration of wealth right at the peak of corporate America. And like you said, so much of it driven by these stock incentives linked to performance.
It does. Okay, speaking of performance and growth, let's shift gears a bit. From the corner office to companies making some really interesting moves, we've got cutting-edge tech and, well, spicy chicken.
Right. Quite the combo.
Let's start with the tech side. The AI boom. Applied Digital. Their stock went kind of nuts recently.
It did, yeah. Soared over 40%. And it was all based on erasing 2 big, long-term lease deals with CoreWeave. For AI data centers, we're talking like 15-year agreements.
Wow. And the money involved sounds huge.
Oh, it's massive. The expected rental revenue over that time, $7 billion. Plus, the deals apparently have an annual escalator clause, so that figure could even climb higher.
That just shows the intense demand for the actual physical infrastructure needed for AI.
Absolutely. CoreWeave brings the high-performance computing side, the AI infrastructure.
And Applied Digital provides the building and the power load.
Exactly. Applied Digital is kicking in 250 megawatts of IT load initially. This is at their big campus up in North Dakota. And CoreWeave has an option for another 150 megawatts there.
And CoreWeave, they're backed by NVIDIA, right? Their stock did well, too.
Yeah, CoreWeave saw its stock jump, too. They've had a wild ride lately. Started around $39 a share back in March, peaked over $130 in May. It's a hot space.
That partnership is a perfect example of the kind of deals this whole AI build-out is creating. Okay, now, shifting to another tech frontier, brain-computer interfaces. Neuralink. Elon Musk's company.
Right. Neuralink just closed a pretty big funding round, pulled in $650 million. And the investor list mentioned in the sources was notable. You had ARK Invest, Founders Fund, Sequoia, Thrive, Lightspeed. Some big names.
So what's the stated goal for that cash infusion?
Well, according to their release, it's about scaling up the tech, getting it to more patients, and developing devices to, and this is a quote, deepen the connection between biological and artificial intelligence.
So the brain-computer interface, the BCI, what's their approach based on what we read?
Their first system is called telepathy, and it involves implanting these like 64 really thin threads right into the brain.
Thinner than a hair, right?
Exactly. Super fine. And they have over 1,000 electrodes on them to record brain signals.
And the first use case is for people with severe paralysis.
That's the initial focus, yeah. Trying to give them back some independence by letting them control computers, phones, whatever, just by thinking. And the report said 5 patients now have the implants and can control devices that way.
5 already, wow.
Yeah. And Neuralink's running 4 clinical trials for telepathy right now.
But Musk being Musk, the ambition goes further, I gather.
Oh, yeah. He's talked a lot about restoring vision, even for people who've, lost their eyes or optic nerve. They actually got an FDA breakthrough device designation for a future device called BlindSight that aims to do that.
It's important, though, as the sources pointed out, this stuff is still pretty far from being widely available, right? Commercialization takes time.
Absolutely. It's still early days, relatively speaking. And, Neuralink isn't alone here. The sources mention others, too. Synchronaut one's backed by Bezos and Gates. Paradromics just did its first human implant, too, apparently. Precision neuroscience. It's a field that's moving fast.
Definitely one to watch. Okay, so from chips powering AI and brains connecting to computers, let's pivot completely. A different kind of explosive growth. Dave's Hot Chicken.
Yes. The hot chicken phenomenon. The big news was Roark Capital, the private equity firm, just bought a majority stake.
And the valuation being thrown around was pretty high for a chain that's still relatively young.
Yeah, the CEO, Bill Phelps, kind of hinted that the reported $1 billion valuation was pretty close. Terms weren't disclosed, but still.
Yeah.
That's a huge number for a place that started in an LA parking lot in, 2017?
It really underscores how fast they've grown.
Unbelievably fast. Over 300 franchise spots now. And U.S. sales just last year jumped 57%, topping $600 million.
Wow. What are the sources saying is driving that success?
A couple of things, it seems. One, they definitely caught the wave of the whole chicken sandwich wars thing. Fast food loves chicken right now.
Sure.
But they also seem to be tapping into this, rising tolerance for spicy food. Apparently, their top heat level, the Reaper, is so intense you have to sign a waiver.
A waiver for chicken. That's memorable, I guess.
Right. The sources also mention their simple menu helps, just focuses on these oversized tenders and sliders, designed apparently so you can eat them with one hand.
Perfect for the multitasking generation.
Maybe so. The reports also highlighted that the core team is staying put. Phelps joined in 2019, the founders kept some equity, and they seem committed to keeping quality up, not rushing things or making the menu too complicated.
And now with Roark Capital behind them, what's the potential?
Well, Phelps is thinking big. He mentioned targeting maybe 4,000 locations globally in the next 10 years. Roark brings that scale, right?
Yeah.
Supply chain muscle, international experience.
And Roark knows this space. They bought Subway last year, right? And Arby's, Dunkin'.
Exactly. They're a huge player, so this Dave's Hot Chicken deal fits right in.
Okay, so whether it's tech or chicken, lots of growth stories. Now let's shift to something more physical, maybe less glamorous, but really important. Office real estate. There was this striking stat about office buildings in the U.S.
There really was. Data from CBRE. It suggests that this year, 2025, for the first time in maybe 25 years or more, the U.S. is actually going to remove more office space than it adds across major markets.
Remove meaning demolition or converting it to something else.
Exactly. Demolition or conversion, compared to new construction coming online.
That's a fundamental shift. What kind of numbers are we talking about?
CBRE projects, about 23.3 million square feet are set for removal this year versus only about 12.7 million square feet of new completions. So yeah, a net loss in the total office footprint.
And the driver's pretty clear, right? The whole remote work shift from the pandemic.
Yeah, that's the main thing. It pushed vacancy rates to record highs. They're still hanging around 19%, which is really high.
But the reports mention maybe some glimmers of hope, signs of recovery.
A few things, yeah. More companies are pushing for return to office. And maybe a tighter job market gives employees a bit less leverage to resist. Net absorption, basically. Occupied space minus vacated space. That's actually been positive for 4 quarters now after being negative for a while.
Okay.
And leasing activity was up 18% year over year in the first quarter. So some positive signs.
So if less supply is coming online and maybe even shrinking while demand potentially ticks up,
Yeah.
that should help stabilize things.
That's the theory. This net reduction in supply combined with maybe slowly increasing demand should help bring those vacancy rates down eventually and hopefully stabilize rents, especially for the really nice new Class A buildings that companies still want.
And converting old offices to apartments is a big part of that removal story.
It is. Developers apparently have another 85 million square feet eyed for conversion soon. And these office-to-apartment projects have already created something like 33,000 apartments or condos since 2016.
That can really change a neighborhood.
Definitely. Brings more people downtown after hours. And there's supposedly another 43,500 units already in the pipeline from ongoing conversions.
But it's not easy, right? The sources mentioned challenges.
Oh yeah, major challenges. Not every old office building is suitable. And construction costs, labor, materials, financing, they're still really high. So it's expensive and complicated to pull off these conversions.
So a big physical shift happening in our cities. Okay, let's zoom out now. Global stage. U.S.-China trade tensions seem to be flaring up again. Looked like there was a brief truce that didn't last long.
Yeah, that's right. They had that meeting in Geneva back in May. Seemed like a bit of a détente. Both sides agreed to lower some tariffs for 90 days. U.S. from 145% down to 30% on some things. China from 125% to 10%.
Sounded promising.
It did. But yeah, less than a month later, things seem to have frayed. Accusations are flying again.
Okay, and just reporting what the sources said, China's side is claiming the U.S. undermined the deal.
Yes, they're pointing to what they call discriminatory restrictive measures. Things like the U.S. export controls on AI chips, chip design software, and also mentioned revoking visas for some Chinese students.
And on the U.S. side, President Trump was quoted saying China totally violated its agreement.
That's what was reported. And Treasury Secretary Bessent suggested part of that was China maybe holding back on releasing rare earths and critical minerals they'd agreed to supply.
Sounds tense. The reports mentioned the leaders might talk soon.
Yeah, a White House official apparently told CNBC that President Trump and China's President Xi are likely to speak, maybe this week, to try and, break the logjam. Secretary Bessent also indicated that was needed. This whole re-escalation definitely weighed on the stock market recently.
And one specific flashpoint highlighted was steel tariffs. Trump proposed doubling them.
That's a big one, yeah. Plans announced to raise tariffs on steel imports from 25% all the way up to 50%, and that immediately got pushback from global partners, especially the EU.
How did the U.S. market react to that specific news? Steel stocks must have liked it.
Oh yeah, U.S. steel companies like Cleveland-Cliffs, Steel Dynamics, Nucor, their shares jumped pretty significantly.
But the ripple effects described in the sources go way beyond just the steel makers, right? It's complicated.
Very complicated. For instance, U.S. automakers, GM, Ford, Stellantis, their stocks dipped. Steel's a huge input cost for them. Analysts quoted expect this tariff hike will make U.S. steel prices soar, mainly because the U.S. imports a lot of steel.
And what about Europe? What's the impact there?
Kind of mixed, it sounds like. On one hand, it's expected to push steel prices down in Europe because supply that would have gone to the U.S. might get redirected there. So European companies that buy steel could benefit.
Okay.
And maybe some European manufacturers who use steel in products they export to the U.S., like cars or appliances, they might benefit from higher U.S. prices.
But downsides in Europe, too.
Definitely. Companies like BMW had already said existing tariffs were hurting them. And the sources mentioned a Danish wind company, Ørsted, could be hit if they need European steel for U.S. projects and don't have a U.S. supply chain set up. The U.K. was also worried about canceled orders.
So it really depends where you are in that global supply chain. And the overall message seemed to be uncertainty.
Huge uncertainty. One analyst basically said, who knows if this will even be the policy in 3 months or even 3 weeks. That kind of volatility makes it incredibly tough for businesses to plan anything long term.
Right. Okay, bringing the tech theme back for a second.
Yeah.
Amidst all these trade restrictions, especially on chips, China's AI industry is still pushing forward.
It is, yeah. China has massive AI ambitions. And even with tighter U.S. rules on advanced chip sales, some analysts are still pretty bullish. Jeffries put out a note saying China's data center demand is growing strong, and their capital spending growth in Q1 actually beat U.S. peers, even when you factor in potential stockpiling.
Interesting. And NVIDIA, who we talked about earlier, they're adapting.
Seems like it. NVIDIA is reportedly working on and expected to launch new chips specifically designed to comply with the latest U.S. restrictions, but still be sold in the Chinese market. So the tech race continues, even with all the trade friction.
Fascinating. Okay, so we've covered company performance, growth areas, real estate shifts, global trade.
Yeah.
Let's pull back even further now. The big macro picture. The Fed, inflation, and this giant albatross of national debt. What are the signals on interest rates?
Well, the sources showed a bit of a range of views, both inside and outside the Fed. Fed Governor Christopher Waller, for instance, he sounded somewhat optimistic recently, said he could see a path for potentially multiple rate cuts this year.
What was his reasoning for that?
He pointed to some recent data points and argued that any inflation bump from tariffs would likely be temporary. He also made an interesting point that even though polls show people expect high inflation, their actual spending hasn't really reflected deep worry.
Is that view shared outside the Fed?
Well, one market strategist quoted, Steve Chiavarone, he thinks the Fed will cut this year, maybe even if they don't know it yet, as he put it.
But not everyone at the Fed is signaling cuts are imminent.
Not explicitly, no. Dallas Fed President Lori Logan, she's not a voter this year, but influential, she said she thinks policy is pretty well positioned right now to just wait, be patient, watch the data, but ready to move if needed.
Okay.
And Fed Chair Powell spoke recently too, but apparently didn't give any specific new guidance on policy. So, there's still some caution, maybe some differing views internally on the exact timing.
Right. Uncertainty around rate cuts, but maybe some leaning towards later this year. Now, let's connect this macro stuff directly to, well, to you, the listener, the national debt. The sources really highlighted how this massive number can actually impact your borrowing costs.
Yeah, this is a connection that's super important, but maybe not always obvious. There were reports about that tax package the House Republicans passed, now heading to the Senate. The estimates vary, but groups like the Committee for a Responsible Federal Budget, Penn Wharton, they project it could add trillions to the debt over 10 years.
Trillions. How much exactly?
Well, maybe $3.1 trillion, maybe up to $3.8 trillion. Once you factor in interest and economic effects, it's a lot.
And the sources noted even some Republicans were worried about the debt impact.
They did. Representative Thomas Massey called it a debt bomb ticking, voted against it. Senator Rand Paul also raised concerns about the math.
And this comes when the debt's already huge, right?
Yeah.
Debt to GDP ratio at an all-time high. Interest payments are massive.
Exactly. Interest payments on the debt now cost more than the entire defense budget. Only Social Security costs more. And yeah, the debt relative to the size of the economy is higher than ever.
So how does that translate into higher borrowing costs for, say, my mortgage or car loan?
Okay, basically, the interest rates you pay on loans are benchmarked against the yields on U.S. Treasury bonds, especially things like the 10-year Treasury note. The government sells these bonds to borrow money when it spends more than it takes in taxes. That's the deficit.
Right.
So if the government suddenly needs to borrow trillions more because the national debt is projected to balloon, it means flooding the market with more Treasury bonds. That can make investors a bit nervous.
Nervous how? Like they won't get paid back?
Not necessarily that they won't get paid back. The U.S. is still seen as very safe. But nervous enough that they might demand a higher interest rate, a higher yield to compensate for the sheer volume of debt being issued, or maybe a perceived, even tiny increase in long-term risk.
And we saw a hint of that risk perception
Yeah.
when Moody's downgraded the U.S. credit rating back in May, right?
Exactly, but that was a signal, made them the third big agency to downgrade the U.S., and bond yields did jump when that happened.
One of the economists cited tried to quantify the impact on borrowing costs for regular people.
Yeah, Mark Sandy had a sort of rule of thumb. He suggested that for every 1 point increase in the debt-to-GDP ratio, the 10-year Treasury yield might rise by about 0.02 percentage points.
Okay, so how does that play out with this potential new debt?
Well, if the debt-to-GDP ratio goes from around 101% now to maybe 148% by 2034, partly due to this bill, using Zandy's math, that could mean your mortgage rate might climb from, say, 7% to around 7.6%, just from that added debt pressure, holding other things equal.
Wow. So it's not abstract at all. It could mean paying hundreds more a month on a mortgage. And it hits investors, too.
Yeah, because when interest rates or yields on new bonds go up, the price of older bonds already out there goes down. So if you hold bonds in your portfolio, their value can drop.
Now, the sources did say the debt was projected to rise significantly anyway, even without this new tax package.
That's true. The trajectory wasn't great to begin with. Projections already had the debt-to-GDP ratio rising substantially by 2034. But as one economist put it, this kind of legislation is like pouring gasoline on the fire. It adds to the problem and makes the bond market, well, unhappy.
Pouring gasoline on the fire. That's a vivid image. Okay, and finally, there was just a brief mention of a really long-term factor, demographics.
Yeah, just a quick note. One indicator looked at the aging population in places like the U.S. It suggested this trend, based on something called the middle-old ratio, could mean stock valuations might peak sometime in the next decade and then potentially face a long-term decline. Just a reminder that these huge, slow demographic shifts underlie everything else over decades.
Another layer to think about for the long haul.
For sure.
Wow. Okay, that was quite the tour through the business and economic world today. We started way down at the individual level, looking at those, frankly, mind-boggling CEO pay packages.
Often tied heavily to stock performance, yeah. Then we jumped into different kinds of growth and innovation, the sheer scale of the AI data center build-out, the really futuristic stuff happening with brain-computer interfaces.
And the perhaps surprising, very spicy success of Dave's Hot Chicken. From high-tech to hot tenders.
Right. Then we looked at the physical world, how remote work is literally changing the landscape of our cities, leading to less office space overall for the first time in ages.
Plus those opportunities and challenges with converting old buildings. Then zooming out, we hit the global stage, those complex, sometimes rocky U.S.-China trade relations.
And how policies like tariffs can create winners and losers in ways that aren't always obvious, rippling through different industries and even across continents.
Then we got into the Fed's thinking on interest rates, the caution, but maybe some hope for cuts. And really drilled down on the national debt, how that seemingly abstract number connects directly to the cost of your mortgage or car loan.
And how it can impact your investments, too. We even touched on those super long-term demographic waves.
What really stands out, I think, is seeing how none of this stuff happens in a vacuum, right? It's all connected.
Totally. The demand for AI chips is tangled up with U.S.-China trade policy, which influences tariffs, which the Fed watches when thinking about inflation and rates, which connects to the bond market, the national debt.
And bam, it hits your borrowing costs. It really shows just how interconnected this whole global economy is.
It really does.
So what's the big takeaway here? What's the provocative thought to leave you with as you process all this? Maybe it's this. We're seeing technology race ahead at this incredible speed, right? AI, BCIs, creating amazing new possibilities.
Yeah, breakneck speed.
But at the same time, you have these powerful, often slow-moving forces, macroeconomic policy, these big international trade fights, the sheer weight of government debt. How are those two things going to collide? How will the fast tech innovation be shaped or maybe even limited by the slower macro and political realities?
That's a great question. Which force ultimately wins out? Or how do they reshape each other? Will the tech push through, or will the economic constraints put the brakes on?
It really makes you wonder what the dominant forces shaping the economic landscape will be in the coming years, doesn't it? Something to definitely consider as you navigate your own financial world.